Greetings! It is time for our monthly monetary report. And as always, we go to this Yardeni report and we scroll down to this first chart over here, where we see what amount of cumulative money printing going back to 2007 each of the four major central banks have done. These four central banks combined represent 85 to 90% of all cumulative money printing in the world. The US Federal Reserve, the European Central Bank, the Bank of Japan, and the People's Bank of China. They're not 100% of all money printing, but the four of them combined are 85 to 90%. And the reason we go to this chart first is we can see that the United States is only about 1/4 to maybe 30% of all total world money printing. Right now it's the joint largest in total with the European Central Bank, but the European Central Bank was more for a long time. But nonetheless, the US Federal Reserve is only 8.4 trillion out of the eventual number that we'll see next. So when people talk about how some worldwide price commodity like gold will rise in price because the US is printing money, these same people have apparently never heard that other central banks are also printing money and the US is only a fraction of the world's money printing. In fact, as a percentage of the size of the US economy, it's very low, as we will see in a couple of minutes. So that whole narrative is bogus. The red line is only 8.4 trillion out of this grand total. And as we can see, all four have been tightening for some time in the whole worldwide coordinated quantitative tightening. But look what's going on here. China and Japan have started printing money again, and pretty steeply. Now, this is just the first month. We don't want to draw any conclusions. Let's see what happens in the next month and the month after that. But they have resumed money printing already, probably because of weakening internals in their own economies. So now we go to this next chart. This chart is just the total of the four lines we saw above in the previous chart. So the grand total is 28.1 trillion. So the United States was only 8.4 trillion out of this 28.1. But notice this rising exponential trend. This is very consistent with my research that shows that there is exponentially rising technological deflation in the economy today that has always been going on, but became significant only in the 21st century, and more specifically only after 2008. Before that, it was too little to cause distortion in traditional macroeconomic statistics, which have a mid-20th century underpinning. But now, we see the amount of cumulative money printing has to rise, and incidentally this matches the quantification of technological deflation in the economy, as I speak about in many other videos. And every time they try and stop money printing, they're forced to do more. So these PhD economists, especially in the United States, the one that has the most regressive thinking, they still believe that money printing is a temporary, unnatural thing, yet they are unable to grasp why every time they try to stop, they have to do more and more. This is the fifth or sixth time that they have tried to reduce and reverse money printing, only to be forced to do more than ever before. They tried to reverse it in 2018, and they were forced to stop the reversal, and they had to resume. Coronavirus or not, this is still reverting back to its exponential trend. And we see here this reversal already is getting back into a printing footing because of China and Japan. Now, to get back to the trend line, they would have to add another 8 to 10 trillion in short order. That won't happen until there's a fiscal crisis, stock market crash, and housing bust, a topic for other videos. But at least this deprinting has already stopped, even though inflation is also going down. So printing has resumed and inflation is going down, thereby confirming my thesis that a lot of money can be printed without any aberrant inflation, which we'll see later in this video. Now we go to this next chart. This chart is just the year-over-year growth rate of the chart above. And I have always maintained that technological deflation rises at an exponential rate that requires money printing to rise at 16 to 24% a year as a compound annual growth rate, meaning it should be in about this band over here. And they only ever touch the bottom of this band and then go below that because they think money printing is unnatural and will cause inflation, even though the last 12 years of money printing did not cause any aberrantly high inflation once you smooth out very short-term noise. So this growth rate should be in this 16 to 24% band. In February of 2021, we very briefly had an unusually high annual growth rate, 46.3%. That is a level at which even I thought there would be aberrant inflation, and this did cause aberrant inflation for a very short while, but that has already been reversed. And now the annualized growth rate of money printing dipped to minus 10%. Minus 10% when it's supposed to be plus 16 to 24%. But it's turning around again, as we saw. China and Japan already see the red flags of too little money printing and too much technological deflation. So they have started printing money again. Also giving the United States political cover to claim that they're deprinting, which is a very bogus political cover, because if the U.S. public has been brainwashed into thinking that money printing is bad, then that's why this very negative type of political cover is even needed. U.S. economic thinking from the PhD economists in the U.S. is still at the stage of where medicine was when they thought they had to drill holes in people's skulls to cure headaches or use leeches to drain blood. That is how far behind the times U.S. economic thought is. So we go to now this next chart. This is the same chart as we saw up in the beginning, but as a percentage of each economy that the central bank presides over. The U.S. is the joint lowest of the four. For all this screeching about how the U.S. Federal Reserve has printed so much money, it has printed only 32.9% of its GDP. And remember, GDP is an annual metric, and this is the cumulative amount of printing over 15 years. And yes, the joint lowest of the four with China, only in the low 30s. Europe has done twice as much, at 65.5% of its GDP in printing for the Eurozone, the currency bloc that uses the euro. You would think Germans would be the most afraid of too much money printing, but even they know that money printing does not cause inflation. So they have done twice as much money printing as the US in proportion to the size of their GDP. But even that is dwarfed by Japan, which has done 4 times as much as the US. Japan has done an incredible 127.6% of its GDP in money printing, and it still does not have any aberrant inflation. In fact, it has too little inflation. Even the people who falsely claim that the US has much higher inflation than is being reported, even those people don't claim that Japan has high inflation. And that's why these people are easily exposed as not knowing what is going on. If they claim that US money printing causes inflation, then how can Japan do 4 times as much and still not have inflation? Now, those of you who watch this channel know the reason. It is because of not just the technological deflation factor, but the fact that both technological deflation and money printing are borderless, so these per country amounts don't really matter. All of these numbers are borderless, and this very large amount of money printing in Japan is merely offsetting the unusually low money printing. Yes, I said low money printing in the United States and China, so that the whole composite is around a happy medium. But then again, it's still not enough based on just what we saw a couple of minutes ago about how the growth rate really has to be in the 16 to 24% band to maintain a cruising speed. Also, the type of printing that is done in the United States is very limited. Only treasuries and mortgage-backed securities are what is being bought, which distorts those two markets at the expense of everything else. They could hardly invent a more efficient way to print a lot of money and not have it go where it would actually have the most benefit, which is ordinary people and entrepreneurial tech companies that can do a lot with very little capital. Instead, it only benefits those who are near the spigot where treasuries and mortgage-backed securities are being bought. So it is really the worst of all worlds. It is sort of like trying to fill a bucket with water by keeping the bucket 6 feet away from the sink and letting the sink overflow onto the floor in the hopes that some droplets splash into the bucket. But that is how these hyper-theoretical PhD economists in the US think, and European PhD economists are not as bad, but still quite bad. It's China and Japan where the more advanced thought in these matters is occurring. Now, from these charts, we go to my next exhibit, which is my scorecard. So at the start of this decade, January 1st, 2020, I said that this decade will see continued exponential money printing. The 2010s decade, which is 2010 through 2019, was $23 trillion of money printing, and the PhD economists believe that is an aberration and is to be reversed, and so their prediction for the 2020s was minus $23 trillion of money printing, a reversal of the first $23 trillion. And I said, no, this is exponential, and that is a good thing. Almost all of this converts into actual gains in living standards for people if it circulates properly, because it does not push commodity prices up, as we'll see later in this video. Therefore, my prediction at the start of this decade, January 1st, 2020, over 3 years ago, was 50 to 100 trillion of new net printing plus. So they're in minus, I'm in plus, and in a larger magnitude. 100 trillion if they continue bond buying, but I think that will be impossible long before the end of this decade. 50 trillion if they do it in the form of cash sent directly to people, because that circulates faster and has higher velocity of money. Therefore, the absolute amount can be smaller, but still $50 trillion when the 2010s had 23 trillion. Now, as of January 25th, 2023, today, how much has been done? plus 8.4 trillion. So are things moving in the direction of what the PhD economists say or what I am saying? Clearly it's going in the direction of what I am saying. And remember, it's not linear, it's exponential. We are 30% of the way through this decade in terms of calendar time, but in terms of exponentiality, obviously nowhere near 30%. So the grand total on December 31st, 2029, about 7 years from now, is going to be in this range of 50 to 100 trillion. Maybe even more. Maybe I was too conservative, but let's see what happens. It's certainly not a reversal of printing, because now to go backwards, they would have to go backwards in terms of 31 trillion of printing, which clearly is not going to happen. So that was the monetary creation chart update. Now we go to part 2 of this video, which is the inflation update, where we will see how so much money printing and even a resumption of net money printing, as we just saw, is somehow just not causing this much feared inflation at all, to the extent that they have to lie about how much inflation there actually is. So we go to part 2. Now, as you know, I have a 3-variable inflation assessment that is very comprehensive and holistic, because you have to get around what the media does, as well as the people desperate to believe that inflation is higher than it is, which is cherry pick either a short time window that's convenient to the narrative, or cherry pick anecdotes such as the price of butter rose, or the price of eggs rose, or the price of the S&P 500 rose, like that's a bad thing. So I maintain that a 10-year horizon is important, and the average annual growth rate over a 10-year horizon is the correct structural measure, not whether inflation was high for 3 months because the same people are nowhere to be found when inflation is low for 3 months. And I say all 3 of these numbers have to be above 3% compound annual growth rate. The US CPI compound annual growth rate has to be above 3%. The Goldman Sachs Commodity Index compound annual growth rate has to be above 3%. This is the most important measurement because it is worldwide, and it is a composite of commodities that are freely traded. So this entire bogus narrative of how inflation is understated deliberately is entirely demolished. That narrative is discredited completely when one looks at the Goldman Sachs Commodity Index. And then the 10-year US Treasury yield, that has to be above 3%. So unless all 3 of these are above 3%, only then do I say inflation is above optimal. If all 3 of these were at 3%, I would say inflation is optimal, because too low inflation, meaning deflation, is also negative unless you have deflation in the Goldman Sachs Commodity Index, because that is an unmitigated good. But deflation in the US CPI and the US Treasury yield would not be good either. So 3% would be optimal. Higher than that would start to become less optimal, but it's not a panic point if it was 3.1, 3.1, 3.1. And much lower than this is, in fact, an indicator that more money printing has to be done, more quantitative easing has to be done. So let's go to the Goldman Sachs Commodity Index first. Goldman Sachs Commodity Index, and the 10-year compound annual growth rate of the GSCI is minus 0.77%, deflation. And that is because oil is lower than it was 10 years ago. Gold is the same price as it was 10 years ago. Natural gas is also pretty low. Silver is also not rising at all. All these commodities combined are in deflation, as one would expect in a technological economy. So all the whining you hear about inflation is completely invalidated because commodities are in deflation over a 10-year window. This is pretty volatile. It can go from deflation to inflation pretty fast, but again, it is in deflation and has been throughout most of the lifetime that I've been tracking this indicator. Now we go to the US Treasury yield. 10-year US Treasury yield is at 3.535%. 3.54%. So it is above 3%. There's a lot of resistance at 3%. You see how it took a lot of force to go above 3%. It was unusually low during COVID-19, and then it started to hit the ceiling of 3%, and it couldn't break through for a few months, and then it finally broke through because the Federal Reserve is raising rates far too quickly. This, of course, is very, very burdensome for the U.S. housing market, and if it stays this high for very long, there will be both a U.S. housing market crash as well as a crash in the U.S. Treasury market, which will greatly inhibit the U.S. government's ability to do deficit spending. But right now, this is above 3%. And remember, this is an indicator of expected future inflation, even though the other two indicators are indicators of past inflation. Now we go to the last one, the BLS.gov website, where we see the US CPI. US CPI at the BLS.gov website, which is in the description box below. So to see the 10-year compound annual growth rate, you have to take this number, 298, divided by this number, 232, because that shows the inflation over 10 years, and then take the 10th root of that, and you can look at earlier videos to see the math regarding that. I'll come back to this in a table we're going to look at in a minute or two. Now, the 1 month inflation level is dipping very low. This flurry that was briefly high is already in the past. It's already negative. 2 month has also moderated down to nothing. 3 month has also moderated down to nothing. 6 month has also moderated down to an equilibrium that existed for the last 10 years. Only the 1 year has not already moderated down, because the earliest months of the last 12 months, so months 7 through 12 ago, are the ones that are high, but it's already dipping down very decisively because all the shorter duration numbers are also dipping down. So this 1 year annual CPI rate, it was high for a very short time. All that media screeching you heard about was due to a very temporary phenomenon. So now we go back to my 3 variable inflation measurement. So US CPI 10-year compound annual growth rate, Goldman Sachs Commodity Index 10-year compound annual growth rate, and 10-year US Treasury yield. What is the answer? Today, on January 17th, 2023, the 10-year US CPI compound annual growth rate is 2.5%. Goldman Sachs Commodity Index is in deflation. I cannot stress this enough. Minus 0.77%. Deflation. And the US Treasury yield is the only one of the 3 that is above 3%. Unless all 3 become above 3%, which is a very low bar for anyone who actually talks about historical inflation. This is a very low bar for all 3 of these to be above 3% due to the correlations associated with them. Inflation is not starting to get high, and this would actually be optimal inflation. This is, in fact, a little bit low in commodities, and an indicator that money printing should resume. But the US CPI is still at 2.5%. So no, inflation is not high. I will debate with anyone about that because I know what all their arguments are, and their arguments are very anecdotal, very emotional driven. That's why we've come up with this video that you see in the upper right hand corner, Kartik's Law of Inflation, where I make fun of this cultural meme of exaggerating inflation into something far, far worse than it actually is. Now let's go to that table of inflation duration snapshots for some further enlightenment. People always talk about that 1 year inflation rate because to them only a 1 year time window matters, because they want to cherry pick their data to support a bogus narrative. Time periods shorter than a year don't matter, and time periods longer than a year don't matter. I say the 10-year rolling window is what matters because that smooths out small amounts of aberrational noise. Now, the most recent reading of the US CPI was negative, minus 0.1%. That means on an annualized level, that would mean deflation, but 1 month, of course, is too short of a sample size. So it's 2 months, but that is 0. 3 months annualized is 2.0%. 6 months annualized is 1.8%. I hope everyone understands how this is annualized. Take 1 month and take that to the 12th power, 2 months to the 6th power, 3 months to the 4th power, 6 months to the 2nd power, a square. 1 year, the CPI reading for the last 1 year is still 6.6%, but it's dropping quickly because all these shorter month series are so low. There was only a very temporary flurry of inflation that is already in the past. It is silly that people are still whining about inflation. The average inflation rate over 2 years is 6.6% because there was 13.7% over 2 years, therefore per year that's 6.6%. Over 3 years there was 15.1% inflation, which is 4.8% a year. Over 5 years, 19.7% inflation, which is 3.7% a year. And over 10 years, as we saw, 28.4% CPI inflation, which is 2.5% a year CPI gain. This brief upward blip has been more than canceled out by periods of unusually low inflation in the past, notably in 2015 as well as 2013. 2.5%. So all that screeching about inflation is very innumerate. You are dealing with someone with extremely poor math skills when they say that inflation is high because only the last 1 year matters, or inflation is high because the price of butter rose or the price of eggs rose, or because their wife's boyfriend's parole officer said that inflation is high, therefore they have to believe that inflation is high. It is quite pathetic to believe something like that and to be the type of person who gets caught up in a nihilistic cult of inflation when there is nothing to worry about on that front. You're extremely fortunate to even be someone who lives in the 21st century, yet you are depressed about some high inflation which is absolutely non-existent. I've been saying on Twitter that inflation has become for conservatives and libertarians what the patriarchy is for feminists. Something that is greatly exaggerated in its power and its malevolence. Both are myths that are non-existent, and therefore conservatives and libertarians on this subject of inflation and money printing have become as anti-intellectual as feminists have become on matters of gender relations. So inflation is already negative in the second derivative, and there are enough months of low inflation that indicate we are more in danger of slipping into deflation than having high inflation in the near future. And then money printing will resume again. So I hope you found this video to be informative, and if you like this type of content, then I encourage you to subscribe to this channel. Thank you very much for watching.